In this video, I would like to explain about scope of managerial finance. Let's look at what is finance actually. So finance can be defined as the science and art of managing money. At the personal level, finance is concerned with individuals' decision about how much of their earning they spend, how much they save, and how they invest their saving. In a business context, finance involves the same types of decision. The first one, how firms raise money from investors. Second, how firms invest money in an attempt to earn a profit. And after they make the profit, how firms decide whether to invest or whether they want to distribute the profit to the investor. So why you need to study finance? Because basically finance affect major areas of organization. Finance affect administration of the company, marketing department of the company, operation management department, and human resource department. For example, if human resource department want to recruit new staff, they need budget to pay the wages. So all the managers, no matter what are their department, they need to study finance, because finance really help you to make managerial decision for the company. So what are the career opportunities in finance? So first, you can look from the perspective of financial services. So what is financial services? Financial services is the area of finance concerned with the design and delivery of advice and financial products to individuals, business, and government. So career opportunities in the financial services, such as you can work in banking, personal financial planning, investments, real estate, and insurance. By having knowledge in finance, you can also hold a post in Department of Finance of the company. So you can become a financial manager, where financial managers administer the financial affairs of all types of businesses. For example, for private and public companies, for large and small companies, or for profit-seeking organization or non-profit organization. All of these type of organization need to have finance department because they involve money. So as a financial manager, you perform so many tasks such as developing a financial plan or budget, extending credit to customers, evaluating proposed large expenditures, and raising money to fund the firm organization. Okay, as a financial manager of the company, you must understand what is the goal of the firm or goal of the company. Basically, all the companies in this world, the main objective is to maximize shareholder wealth. Or basically, you want to maximize the income or the profit or the asset of shareholders. Basically, shareholders is the owner of the company. So when you want to when you understand what is the goal of the firm, then all the decision that you want to make as a financial manager, you must make sure that your decisions can maximize shareholder wealth. So if you refer to this diagram, figure 1.2, you can see that as a financial manager, you need to do a lot of financial decision. For example, you want to invest in a new project, or you want to make a new loan to finance your company. All those things is the financial decision of the firm. So in order to analyze all the alternatives to make financial decision, you must analyze based on the return of the decision and the risk of the decision. In finance, we believe high risk, high return, low risk, low return. Okay, so to analyze the risk and return, we have one special chapters. So when you analyze all the financial decisions that you want to make, you have to ask yourself or your team whether the decision will increase the share price or not, because shareholder wealth is calculated based on the share price. Okay, so if your decision can increase the share price of the company, then you should take that decision. Okay, if the decision will decrease the share price of the company, then you should reject that decision, so that you can make sure that your decision can increase the share price, so that you can achieve the goal of the firm, which is to maximize the shareholder wealth. So we talk about the goal of the firm is to maximize shareholder wealth. So is it only you focus on the shareholder wealth, which is the share price of the company? No, in order to maximize the share price of the company, you must also take into consideration the other stakeholders for the company. For example, employees, customer, suppliers, creditors, and owners. Because all these stakeholders can affect the performance of the company, and indirectly it will affect the share price of the firm. For example, you don't take care your supplier. Okay, you pay late for your supplier. Your credit term is 30 days, but you pay in 60 days, for example. Okay, so then supplier will not send you the raw material, so it is affect your production. When your production is affected, of course it will affect your sales. So when your sales drop, then it will make the profit of the company decrease. So profit decrease will cause the share price decrease. So at the end of the day, you're not only taking care of the share price of the company, but you must also take care everybody who involved in the performance of the company. Okay, for example, if the employees is not happy with the financial decision of the firm, so it will affect their productivity, and at the end it will affect the performance of the company. So in order to achieve shareholder wealth maximization, you must look at the share price, and also you must take care all your stakeholders in the company. So next, we talk about ethics. So what is ethics? Ethics is a standards of conduct or moral judgment that apply to a person engaged in the commons. So basically, ethics is not stated in the law. Okay, so basically, you can do that, but it's not really good, or it's not ethical. Okay, for example, non-ethical conduct in financial manager is creative accounting. Creative accounting means you report differently, so that you can mislead the reader of your financial report. For example, let's say you involve in the one industry, and the norm of the industry to report inventory management is based on FIFO method. FIFO method is first in, first out. But in order to make your company looks good when reporting the income, your company decide to use LIFO. So it's not wrong. It's permissible by the law, but it's considered as a creative accounting. Or you can make a misleading forecast. For example, as a CEO of the company, you want to ask your board of director to buy one company. You know that that company is not a very good company, but you ask your director to buy that company. Okay, so that is misleading forecast. And then, for example, another one is insider trading. Insider trading means you trade by using unpublished material. For example, in finance, let's say the company announce first quarter they make profit. Okay, so if the company announce first quarter they make profit, usually that good news will cause the share price increase. Okay, so you know that next week your company is going to produce that report. So today, what you're doing as a financial manager, you know that good news is going up to the market, so you buy shares of your company today. Okay, so that is considered as an insider trading, because you trade the company's share by using unpublished material. So why we need ethics in business? Okay, next we talk about corporate governance. So what is corporate governance? Corporate governance refers to the rules, process, and law by which companies are operated, controlled, and regulated. It defines the rights and responsibilities of the corporate participants, such as the shareholders, board of directors, officers, managers, and other stakeholders, as well as the rules and procedures for corporate decision. So basically, corporate governance will govern the organization. Okay, you can see this example of corporate organization. So if you see that there is a separation between owners and managers. So usually company, for example, listed company, they have many stockholders. So stockholders is considered as the owners. So stockholders, okay, will elect board of directors. So board of directors could be somebody from the stockholders, or company can elect anybody to become the board of directors. Then board of directors will make decision to hire a CEO. So basically, CEO will run the company based on the direction of the board of directors. Okay, so if you can see that here, there is a separation line between the owners and managers. So CEO and all the employees below the CEO is considered as a manager or workers in the company. So this is an example of corporate governance. Now we look at the governance and agency, the agency issue. First, you must understand what is principal-agent relationship. Okay, principal-agent relationship is an arrangement in which an agent acts on the behalf of principal. For example, in the company, shareholders of the company elect the management to act on their behalf. If you refer to the previous corporate governance organization, you can see that shareholders is the owner of the company. They will appoint a board of director, and then board of director will appoint the CEO. So in this example, board of director and the shareholders is considered as a principal. CEO is the agent who act on the shareholder, who act for the shareholders in making business decision. So agency problem arise when manager place personal goals ahead of the goals of shareholders. Maybe CEO make some business decision that is not good to the company. Okay, so that is the agency problem. So when agency problem arise in the company, then the company need to bear the agency cost. What is agency cost? Agency costs arise from the agency problem that are borne by shareholders and represent a loss of shareholders' wealth. I give you one example. Let's say you as a shareholders of the company, and you appoint me as the CEO, and then I make some business decision that is not really good for the company. For example, let's say I want to help my brother's company. So I propose to the shareholders, you need to invest in this company. Even though that I know that my brother company is not really a good company, they can't make any profit. So that is the agency problem, because I put my personal goals ahead of the company's or shareholders' goals. Okay, so then you as a shareholders, you accept my proposal and you invest in my brother's company. Okay, so suddenly my brother's company goes bankrupt, and as an investor, you need to bear the loss. So that loss is considered as a agency cost. So how to solve agency issue problem? You can solve this problem by using two methods. Okay, the company can solve this problem by using two methods. The first one, you use management compensation. Management compensation, for example, you can give incentive plans to the CEO. So management compensation plan ties to share price. For example, you set a goal for the CEO. If the share price achieve 10 ringgit next year, then the CEO will receive bonus. or extra money. Or you can put performance plans the time management compensation to measure such as EPS or growth of EPS. So maybe you can say to the CEO, okay, if you want to get extra money, then you have to make sure that the EPS earning per share of the company achieve certain level. Or you can give cash bonus to your CEO. Okay, cash paid to management for achieving certain performance goal. Okay, you can use trade-off takeover. Okay, like I said previously, a good CEO is a CEO who can manage a company in a good way so that they can take over other company. Okay, but a bad CEO is a CEO who receive a trade of takeover from other CEO. Okay, so let's say I'm managing my company, I make a lot of agency problem in the company. For example, I make a lot of decision based on my personal goals, not based on the shareholders' goal or company goals, which is to maximize the shareholder wealth. At the end of the day, my company perform very bad, so the share price is decreased. When share price is very low, it will attract trade of takeovers from other company. Okay, so trade of takeover, when I see that my company have a trade of takeover, automatically I'm as a CEO want to protect myself, so I will start improve my financial decision, my business decision, and I try to improve the performance of the company so that when the company performs better, the share price will increase and it will stop the trade of takeovers from other company. Okay, so that is trade of takeover. Okay, that's all for lecture chapter 1.